Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. What a joy to be back with you again today as we take a look at a ubiquitous part of our modern culture, but an aspect of it that remains mysterious and very hard to understand for me. I keep trying to understand it and just can't get a grasp on it. But with us today is an expert in blockchain and the evolution of the real estate market as it pertains to blockchain and tokenism. So I am delighted to have with us Sohail Hassan, who is a multifamily real estate developer and a managing partner at MarketSpace Capital with extensive experience working with energy, technology, and commercial real estate. So, Sohail, take us into the show and share an experience that helped you to be who you are today.
Well, thank you, Alan. Once again, appreciate you inviting me to be a guest on your show. And it's a pleasure to be here with you today and to talk a little bit about blockchain and tokenization. But, to answer your question, I look forward to personalizing this a little bit more so that hopefully your listeners can come out of this learning just a little bit more about how this technology really has the potential to disrupt the real estate industry.
Terrific. So share with us an experience that helped you to be who you are today.
Yeah, so I would say that going back through, there's certain milestones or experiences that one achieves in their life that really kind of gives them a different vision of reality. And I would say my freshman year of college at Texas A&M University in 2003 was at that time around when the Kyoto Protocol was happening, which is the first time that the major powers in the world were coming together to discuss the topic of climate change. And that's really what kind of led me down the rabbit hole of understanding, our potential negative impacts on the planet, particularly when it comes to energy consumption. And ultimately that kind of led me to seek a career where, I really wanted to understand the way that we consume energy in this country and how that was being impacted through technology such as solar and other renewable energies. And so through that, I ended up having my first startup that was a technology company for the solar industry, which I worked on with a partner of mine for 4 years, in which we exited in 2017. And that's at that time when I was really looking at what was next for me, Alan, and understanding what generates true wealth in this country. That's kind of what led me down the path of discovering real estate. And since then, I've been focused on this sector and founded the company along with my partners that focuses on value add acquisitions as well as ground up developments of multifamily properties all across the country.
Well, interesting trajectory there. Let's get into blockchain technologies. And all of us have heard of blockchain. I think very few of us really understand blockchain. So if you can just kind of break that down as in a layman's terminology so that I can understand that. That's going to be a challenge, but try.
No, absolutely. So, I guess I should preface it by saying that when myself and my two partners, David Rodarte and Dr. Masaki Oishi, met for the first time to discuss, starting MarketSpace Capital, the goal at that time was really understanding how technology can be used to disrupt this industry. And that technology we're talking about is, of course, blockchain technology. And you may be familiar with it because it is often associated with things like Bitcoin and Ethereum. But it's important to note that blockchain is the technology behind these cryptocurrencies that allows it to function. And in its most simplest terms, blockchain technology can be seen as an immutable network, right? It cannot be manipulated. It cannot be changed. And it is for that reason, the inherent security in this protocol that allows for cryptocurrencies to exist, just like Bitcoin. But the actual use of this technology can be applied to a variety of industries. And we see it already being done today. The lowest hanging fruit of that is kind of financial technology, fintech. But, when it comes to real estate, I mean, you're talking about almost every part of the real estate transaction can be impacted, right? From titles being recorded on the blockchain to transactions actually happening, and even tokenization, which is, of course, what I'm here to talk about today.
But certainly what I've always heard, Sohail, in terms of the blockchain is that it is immutable and it cannot be changed. And I guess that's one reason that it's difficult for me to understand and accept it, because I'm like, I just can't trust that. So how can I trust the fact that the blockchain is actually immutable?
So the current way that it's set up, the proof of work system that's currently done, it's basically done in such a way that if you were to try to go and manipulate that one block, that you would have to manipulate all blocks within that one chain. And which is, impossible actually, right? Now they're saying with like quantum computing, you're able to get to a point where maybe those algorithms can be solved and then manipulated. But even that, it's going to take a ridiculous amount of resources to be able to do something like that. And so as a result, again, this has created kind of a decentralized currency, right? That's ultimately what it has powered in the form of Bitcoin and Ethereum and all these other altcoins, is that it essentially, is allowing for transactions to take place. Now, there's other forms of, this blockchain. There's things that are called NFT, non-fungible tokens. But it's important to distinct that, what we are actually talking about is digital security tokens, right? And I think, and Alan, the way to kind of bring this home so that you and your listeners can really understand is to compare to what a traditional real estate investment looks like, right? Mm-hmm. So, Alan, if you were to come and invest with us today in a ground-up development project of ours, we have a minimum investment of $50,000, right? Now, that $50,000, you would sign a subscription agreement. And that subscription agreement essentially says that you own certain shares of an LLC. And that LLC, of course, owns the underlying asset. So in this scenario, the same exact principles apply, right? In the traditional scenario, you're locked into the partnership. You're not able to get your money back or get out of the partnership until there's a liquidity event, we refinance, or we decide to sell the asset, right? So you're kind of locked into this. So with the advent of blockchain and specifically tokenization, you're essentially able to do things that are, a little bit different, right? So in this same scenario, you would still sign the same paperwork with us. And instead of you owning a piece of paper saying that you own 50,000 units, we would issue you 50,000 tokens. Now, these tokens, one token equals $1. Okay. And we use what is known as a stable coin. Stable coin, particularly the technology, is called Circle. And they use a token that's called USDC. And this stable coin is tied to a fiat currency. So in our case, it's tied to the US dollar, of course. So your one token equals $1, and you don't see the fluctuation or volatility that you might inherently see within Bitcoin. So your one token always is going to stay at $1, right? Now, you come in and you invest. Now you have these 50,000 tokens that are essentially, deposited into a digital wallet. Think of a Charles Schwab app that you have on your phone. You would have the same exact setup. You would be able to log into that app and you would see that your 50,000 tokens are sitting there. Now, after 12 months, Alan, you have the ability to take those tokens and start trading them on a secondary market. Okay, the secondary market that we use is a company called T0. T0 was founded by the Overstock.com guys. And if you may recall, Alan, Overstock.com was one of the first online retailers that started accepting cryptocurrencies. And so they were a believer of this from the beginning. And so the founders went off and started this exchange called T0. And currently it is the only SEC FINRA approved secondary exchange, right? There you have the ability to buy cryptocurrencies like Bitcoin, Ethereum. You can buy stocks. You can buy NFTs. And now, of course, you can buy digital security tokens backed by real estate, such as what we are doing. Okay. So after 12 months, Alan, you have the ability to take these tokens and put them onto this secondary market. Now, anyone, anywhere in the world can come onto this T0 platform. They sign up for, service. They go through a KYC process. They actually have to go through a pretty robust, identification and KYC process. And then once their account is created, they have the ability to start buying these tokens. So they can come to you, Alan, and they can say, Alan, you bought this token for $1 in this asset, and I'd like to offer you $2 for each of those tokens. But, I only want to buy 5,000 of them. So in this scenario, Alan, you now have the ability for fractionalized ownership into real estate assets. So you can say, okay, I have 50,000 tokens. Now somebody's offering me double the money. I paid $1 for them. Now they're offering me $2. And I only have to sell 5,000 of them. So you have the ability to conduct this trade and essentially sell your tokens on the secondary market. So what this does, Alan, and I'll get into a little bit on the value of how we're estimating the value of these tokens. But before I do, I just want to kind of take a step back and help you understand kind of the two biggest pain points that this is solving. First and foremost is the inherent lack of liquidity in real estate investments. Again, you are locked into our investments, usually for a minimum of 5 years, right? So that allows us enough time to build the asset, stabilize it, refinance, cash flow, and then eventually sell. So in this scenario, again, we are essentially eliminating that issue because after 12 months, you have the ability to sell these tokens. Now, the second biggest drawback to investing in real estate is typically the high ticket cost. As I mentioned, our minimum investment is $50,000. Most of the US population, something like 93%, are not able to invest in our deals simply because they're not accredited investors. Right. So you're leaving out a large part of the population. And we're only talking about United States. Imagine the entire world. So by essentially allowing the secondary market, again, you're allowing for fractionalized ownership and therefore eliminating the high ticket costs to participate in these investments. So before I get into telling you a little bit about the value of the token and kind of getting into that, I just want to take a moment to see if you had any other questions for me so far.
Well, I'm totally baffled. It still is overwhelming to me, and it's just a lot of information to take in here. So I don't even know where to begin in terms of asking questions of value. But let's just take a moment here, Sohail, and tell our viewers and listeners how it is that they can get in touch with you to learn more about these kind of things.
Absolutely. Well, from day one, we've taken an approach of documenting everything that we're doing and, making it available for the public. So we've written white papers, we've written blog articles, and we've done webinars we've hosted. All of this is available, of course, on our website at MarketSpaceCapital.com. If you go to the Learn section, you'll see a plethora of information available on this topic.
One question that comes to mind is that after the first year, I can go on to the secondary market and I can sell all of my tokens or I can sell a portion of my tokens. That's where I guess I'm getting really, really lost because first of all, to invest in the front end of any of your investments, I have to be an accredited investor with a minimum of $50,000. Right. How is it that I can then go into the secondary market and fragmentize that investment? That just seems to me to illegitimize the purpose of the accredited investment in the first place.
Absolutely. So let me break that question down to you with the real life scenario, because we have actually gone through the process of tokenizing our very first real estate asset. And this is for, Alan, a ground up development of 250 units, which is in Dallas, Texas. This is a luxury apartment complex. It's a 5-story wrap. So meaning, here we call it a Texas donut, and it has a parking garage, podium style parking garage. And so this is a project that is currently under construction in the city of Dallas. And we are building this project for, 250 units is around $65 million. Or if you did the math, that comes out to right around $260,000 per unit. Now, the project, Alan, was appraised at a stabilized value of $75.6 million, or right around, right above $300,000 a door. So that's essentially the business model, right, Alan? We're building at 260. Once it's stabilized, we refinance and it's going to be worth somewhere around 300-ish, right? That's our business model. So in this same scenario, we went and we raised equity in all of the deals that we do. Typically, we get right around 75% leverage, right? That remaining 25% that's left over, the partners at MarketSpace Capital will put in 5% from our own pockets. And then the remaining 20% we go and we raise from outside investors such as yourself. And we did exactly that for this project, where we raised $7 million of limited partnership equity through about 70 investors. Okay. Now, we started construction on the project. And again, I want you to know, Alan, the conversation around blockchain for us started in 2017. But we understood that the technology was still in its infancy and that we should just take a traditional approach to investing in real estate and build up our assets under management. Today, we're blessed. We have around $488 million of multifamily properties under assets under management. And then we have about $1.3 billion of assets that are currently under construction, development. And so we have very much been investigating and continue to investigate since that 2017 timeframe on the impacts of blockchain to real estate. And I would say about 2 years ago, Alan, that's when we started spending a significant amount of time, money, and resources on this. And that's when we developed a strategic plan to essentially tokenize our first asset. And we thought that the Myra Park project is an excellent case study for us to do so. And the reason being is because we had already raised the equity. We had already started construction on it. And as we will get into in a moment here with you, the value of the token is really advantageous from the ability when you're working on a ground up development project, simply because you're creating so much value in the asset, right? So from that perspective, after spending a significant amount of time on this, and like I mentioned, over almost, 6 figures now in tax consultants, attorneys, understanding, the implications to our investors, the software element, the investor side, how do investors know the tokens and how do we have that reflect on their investor portal? So all of this is kind of what we've been unpacking over the last 2 years. And finally, we went through the process and completed the tokenization of this project in Dallas. Now, what you should know is since we're using T0 as that secondary market, it's really akin, Alan, to taking a company public. It's the same kind of due diligence, background checks, and information that goes into when you're actually taking a company public and ringing the bell. You're pretty much doing exactly that in this scenario, except it's being tokenized, right? And it's being put onto this secondary platform. Now, as we go, you invested $50,000 with us, and that token cost was $1, right? The share value of that token is the value of the dollar. But as we complete certain milestones through the project, Alan, for example, we are currently 30% through the construction of this project. We're about to start going vertical. So clearly, we've already spent roughly $15 million on the site, right? Utility, site work, getting all of that stuff done. So as you're completing certain milestones through the project, the logic follows that the value of your token is also increasing. So that token that you bought in at $1, once the project is complete and it's stabilized and we have net operating income coming in, the value of that token, according to our projections, is going to be closer to $4. Okay. Now the token, if you are a token holder, it's the exact same scenario as if you had subscribed to our investment. You signed a subscription agreement. We, in fact, took the same terms. So all of our investments have an 8% preferred return for the investors, which I'm sure you're very familiar with. And then we have a 70-30 split on the back end after a return of capital and a return on capital to the investors. Then it goes to 70-30, 70% continuing to go to the investors and now 30%, of course, coming to us. So this same exact terms of this subscription agreement have now been embedded into a smart contract. And this smart contract is built on the Ethereum protocol. If you've ever heard of Ethereum, you have Bitcoin and then you have Ethereum. Bitcoin is kind of like a currency side of it, and Ethereum is meant more for transactions, like smart contracts. So the exact terms of this subscription agreement have now been put into this smart contract. And the way, Alan, I would like for you to think about it, a smart contract is like a vending machine. Okay, it just performs the function that you program it to. So a vending machine, you input money, you make a selection, it spits something out, right? Those same terms, right? That same concept is now built into this. So the smart contract has already kind of coordinating the structure for this investment. So meaning that you're going to continue to get 8% preferred return. And then once we refinance the project, you usually get cashed out. And then you just start receiving cash flows. Now, imagine for us as a sponsor, and when I have to go and do distributions, Alan, to investors, I mean, it is like kind of a nightmare process, right? Our projects typically have around 100 investors. We have a ton of different bank account information. Some of them are international. So imagine if I could eliminate banking institutions entirely, and I could just do distributions via tokens to their digital wallet. Mm-hmm. So now I can issue you tokens that automatically get sent to your digital wallet. And even in the future, all of your distributions are all now just coming straight to your wallet. There's no banking fees involved. There's no third party involved. It is a direct peer-to-peer. Now you have the ability to take those tokens at any time, Alan, and convert them right into US dollars, right? At the click of a button. But these tokens can sit in your wallet. And again, you have, after that 12-month timeline, you can always go and sell. Now, with that being said, we are currently 30% through the construction process, and we just had the very first transaction that was completed for this asset. An investor who invested from the beginning, they were accredited. They invested with us through normal, typical means. After 16 months, they needed the money for it. They wanted something, right? They obviously needed the cash. So they went and to the secondary market and they sold their tokens at $1.34. So they made a 34% increase immediately on their investment from when they made it. Now somebody else has come in and now they are the owners of the tokens at $1.34. Now all of the rights that were attributed to that original token holders in terms of receiving the preferred return, in terms of the distributions, all of those rights now belong to that token holder.
Even though they're fragmented.
Even though it's fragmented. And everything is being recorded on the blockchain. So all of these transactions are being recorded, again, on a ledger that's immutable. And every single day, there's essentially same-day settlement happening. So theoretically, our cap table for our LP investors could constantly change. I mean, we've only done one transaction, and I'll get into a moment here why that is. But theoretically, there could be hundreds of trades, people buying the token and selling the tokens. And all of this is being tracked on the blockchain and within our cap table, and then automatically sent to our CPA. And then our CPA, depending on how long you held that token, can issue you K1s and taxes to your respective account. So ultimately, this is the way that we see this industry going, Alan. I would estimate by the end of this decade, we will be in a position where you'll see transactions happening more and more like this because of the simplicity of it, not only from my end as a sponsor, but imagine you, Alan, you now have options. You have liquidity options. Why would you not do this, right? Everything else is essentially the exact same. And getting back to the value of the token. So if we projected that once the property is stabilized, as we're collecting rent, as you know, the way this works, we collect rent from all the tenants. We pay off the operations, the lighting bills, the management, debt service, whatever is left over is going into a bucket. And on a quarterly basis, we do distributions to our investors. First and foremost, you should know that, when you're talking about things like Bitcoin, it's really hard to peg a value because at the end of the day, it's the technology, right? Exactly. It's nothing tangible there.
Exactly.
But here, you're taking the best of both worlds. You're basically taking a digital asset, but you're backing it by something that's real, tangible, that you can touch and feel. And Alan, in our industry, what do we use to validate real estate prices? Appraisals. So we have gone and we have struck up a partnership with our appraisal, very reputable, one of the largest appraisal firms in the country. And, we obviously paid a great deal for the original appraisal, but now we have a contract with them that 4 times a year, they go and they update it based on market conditions. And then that figure that they come up with in the appraisal is essentially how we're backing into what the value of the token is. Mm-hmm. And of course, that's all correlated to the net operating income, right? Just like the value of any other property, right? How it's performing. And then that same correlation is, so that's how we come up with the idea that your $1 token that you originally invested in, by the time it's all said and done, it's going to be worth closer to $4. So if you're an investor with us, Alan, why would you sell? If you know that you bought it at $1 and one day it's going to be worth $4, why would you even want to sell, right? So that's kind of where we're in the position where we've only essentially had one investor that had the need to sell after 16 months. But most of the other investors and most people with real estate have that in their mind anyways. They just make the investment and kind of leave it. But now after 12 months, you literally have the ability to go and trade this at any price. And you're willing to sell it at $2 and that person's willing to buy it knowing that there's still meat left on the bone for them to take advantage of once they're the token holder.
Yeah, life happens. That is the big issue with real estate is no liquidity. But what I'm understanding here is that through this blockchain and through tokenization, you have essentially given a platform where people can invest in this as easily as they could go to the open stock market and purchase a stock. The difference is that in the stock market, you're purchasing a piece of paper that could drop in value significantly tomorrow, whereas with the tokenization, you're purchasing an asset that is backed by a tangible asset. It just sounds too good to be true. In 1 minute, tell us the downside.
Regulations right now, it's still the Wild West, right? This project in Dallas that we did is the very first ground up development in this country that has been tokenized. There's been other projects that have done this. There's a St. Regis Hotel in Aspen, Colorado. That's perhaps the most famous case study of this. But regulations are still coming down. We don't know what that's looking like. We welcome that. As a sponsor, we already collect a lot of financial information on our investors to ensure that they're accredited. So we are welcoming to regulations because we believe it's going to weed out the bad actors. Mm-hmm. But that, of course, that and tax, how to tax this, they're still a little bit behind from where we are in terms of, the market. And so that's kind of what some of the potential risk that we see moving forward in the future. But these are nothing that cannot be overcome.
Enlightened investors, what a show we have had today. I am so delighted to have Sohail with us, and I am sure that you are as well. I know we're just scratching the surface on this, but you can find Sohail's contact information in our show notes and learn more about blockchain and tokenization, and also learn what Sohail, Hassan, and his company have to offer you as private investors. Thank you, Sohail, for being with us. What a pleasure it's been.
Thank you, Alan. You take care. Bye-bye.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.